Okay, in this chapter we're going to talk about stocks, a little bit about the marketplace itself, how stocks are ultimately kind of sold, but we're going to start talking about the valuation process and the steps to try to figure out what a stock should actually be worth. So if you own a share of stock, how do you get paid? There are typically two ways. You get dividends. If the company distributes some of its earnings, you will receive a dividend. And then, of course, at the end, you have the stock price. You can ultimately liquidate your investment, and then you will get compensated, obviously, for the price of the stock. With bonds, it was the same basic idea, right? The dividends related to the interest or the cash income, and, of course, the selling piece related to the principal or the capital gains that you ultimately would receive. So they're very similar. The difference between the two in the end is uncertainty. So let's think you're thinking about buying a stock, and you expect that you're going to pay $2 for that stock in 1 year. You think you can sell the stock for $14 at the end of that time frame. You require a 20% rate of return on your investments. So the question we have, and this is the question of the chapter, is what is the maximum that you'd be willing to pay to purchase this stock? Now we can do a very simple time value calculation. We'll use a 1 period example. The next year's dividend is $2. You're also going to receive $14 the next year. So at the end of the year, you'd receive $16. And of course, the current required return or discount rate is 20%. So the present value of $16 1 year from now at 20% is $13.33. So that's what they're referring to here as being the 1 period model or example. What about the 2 period example? How does that play? Well, again, next year's dividend is $2. And let's say that we think that the next dividend after that's $2.10. So how would you calculate this? So now we have the present value of $2 1 year out, and then the present value of $2.10, the dividend year 2, plus the estimated cost of $14.70. Again, it's $13.33. It's the same price. That's the 2 period example. And of course, we could do the 3 period example. And the idea here is that the present value of all of the future stocks could ultimately, they should ultimately be equal, right? You can tend to push this back and back of when you should sell the stock. And what we would find is that the price of the stock is just the present value of all of its expected future dividends. So we have a model. That here is the present value of each one of these dividends. Now we're assuming that we're going to go clear to infinity. So there's a very long lifespan on this company. So this is just the summation, if you will, of the present value of all of the dividends into the future. Again, these are future dividends, not past dividends, but the future dividends of the company. So we're going to be looking at some different models. There's a constant dividend or the zero growth model. There's the constant dividend growth model. And then there's the supernormal growth model. Now these first two models are really identical. The formula for these is identical. For some reason, textbooks feel it's very important to illustrate or talk about the zero growth stock. Since we have preferred stock essentially are fixed, it gives us a model for preferred stock. And essentially it's a perpetuity formula should we want to have that type of a calculation. It's a very simple calculation. But in the world of the simplicity, or trying to make things as simple as possible, why don't we just have one model that fits all possible stock prices, and then we don't have to worry about it so much. So that's what we're going to talk about as we move forward. We're going to use just one model to explain what happens with dividend growth. Supernormal growth is basically, it says that dividends for some reason don't grow consistently. Now we're just going to use a one-step model. There's a company comes up with an innovation or a new product that provides some extra earnings for a short period of time. After those extra earnings, competition is going to catch up, and then they'll revert back to their average rate of return. So again, we will discuss that as we move on. And again, here's just a little bit, we're just going to concentrate on this one model with respect to these dividend techniques. Now, what I'd like you to do is just take a second, and if you have the spreadsheet open, you can pause this model and open the spreadsheet so that you want to go to the stock valuation spreadsheet within the workbook. So if you click on stock valuation, here is this valuation worksheet. Again, you can see mine's kind of busy because I do a lot of problems out here. But if you just kind of go back and you delete the yellow boxes, you'll be able to kind of see just the empty base kind of formulas and things that we're going to be working on. So we're going to talk about this in several ways. Here's the basic of the model. You'll see this in a formula here in a second. We only need to know three things: the required return on the stock, the growth of future dividends, and next year's dividend. We're going to talk about how do you figure out or calculate K sub S, or the required return. Again, in your textbook, they might use R sub S, but R and K in the finance world, they mean the same things. We're also going to then have to talk about how do you find the growth rate of future dividends. Well, we only have history to look at. So we have two methods to look at here that will help us calculate or estimate what the historical dividend growth has been. Once we know that, then we can make some adjustments based on company analysis. So let's go ahead and get back to the spreadsheet or to the presentation here, and let's talk about the different models. And we are going to independently talk about, we're going to use the same spreadsheet here. This stock is going to pay $2 in dividends every year, and the required return is 10%. So what is the price? The price of the stock is the $2 dividend, is $2 in the future, is $2 today, because it has a zero growth rate in the dividend. 10% is the required return, or the K sub S, or the R sub S. So this stock has a value of $20. So if I were to tell you that you could buy this stock for $18, would you pay $18 to get a stock worth $20? And of course you would. If you did that, if you actually paid $18 and we were to calculate your expected return on these cash flows into the future, you would expect to earn around 11.1%. Now the required return, based on the riskiness, inflation, real rate, etc., is 10%. So if all you really wanted was 10%, but this investment was going to pay you 11%, then obviously you would like to purchase this bond or this stock. Now there is one little trick to this spreadsheet, and it has to do with how you enter the dividends. In this example, you're just told that the most recent dividend is $2. So there has to be a number here under D0. So you'll have to put a number in that box. We'll talk about an example where some problems give you some other information. We'll do that example maybe a little bit later. But you have to remember to include the $2 here, or the beginning dividend there. So again, what dividends are we talking about, right? Well, D1 is the current dividend times 1 plus the growth rate, and this is the exponent. So this is just the future value of D0 1 year out. This is the formula for the dividend 2 years out, out to T. D0 is the dividend that you just paid. Now, one of the questions we have is, and I pose this question, is do stocks actually grow this way? Do stocks grow in a steady, smooth, consistent way? And the answer is, of course not. We have to have some way to equate and quantify those future dividends. So we place in there an assumption that dividends are going to grow at a constant growth rate. We know that they don't, but that's how we're going to work this particular model. So now we have a formula. We can take this formula, the present value of all future dividends, and if we do a little algebra to this, we can solve this formula to infinity so that the value of a stock is the current dividend, d sub 0 times 1 plus g, where again, g is the growth rate of future dividends, and then we divide that by the difference between the required return, r sub s, or k sub s, minus the growth rate. And again, this g is the growth rate of future dividends. So it kind of boils down to where we talked in the very first slide there from the spreadsheet, that the formula, in order to calculate the value of a stock, you need to know three things. You need to know the future dividend 1 year out, you need to know the required return today, and the growth rate of future dividends into the future. This model, by the way, is referred to as the Gordon growth model. It's used by many brokerage firms. They all utilize some form of this from, at least to give a basis or a beginning point, if you will, of evaluating the current values of stock prices. So here we have this company just paid a 50-cent dividend. They expected to increase its dividend by 2% a year. The market requires a return of 15% on its assets. Based on the risk of this company, what should this stock be selling for? So if you plug the numbers, you can do the math, certainly plug it into the formula, or you could use the spreadsheet. Again, this is the stock valuation spreadsheet, and type in the numbers you know. You know that the most recent dividend just paid, the last dividend, D0, is 50 cents. Required return 15%. They give you a 2% growth rate. So this stock should have a value of $3.92. Now, if I were to tell you that this stock was currently selling for $4.25, would you purchase this stock? So in other words, would you pay $4.25 to buy something worth $3.92? And of course, I hope you see that the answer is no, you wouldn't. However, if you did buy the stock for $4.25, you would earn 14%. Now, most of us would think 14% isn't all that bad, but for the riskiness of this company, we really would like to get at least 15% on this particular investment. So the return that we're expecting to get is not as much as what we would require to get. So let's look at example 2. Again, we're going to get a $2 dividend. Now in this case, the $2 dividend is going to be paid in 1 year. Now here's where I tell you about this little sneakiness, if you will, right? We can put this 50 cents here. It doesn't do anything for us for this example. There is a box that says if D1 is given, you enter it here. There's where the $2 comes in, and that transposes up here as the $2 under D1. There's the 5% growth, 20% required return. Stock value is $13.33. You could sell it, if you could buy it for $12, you certainly would. If you bought it, you'd earn 21.7%. You only wanted 20%, so this is a good investment. So here is the trick. If you know what next year's dividend is, if it's given to you, it will rarely be given to you except in homework. You put it in this point right here where it says 2 for D1. Now what you have to remember is when you're done with this one, you have to delete that when you're done with this problem, because it up here under D1 shows up as a formula. The formula says if this number is not 0, put it here. If not, do this number times 1 plus g. So you have to watch the formula. It's the one little trick, if you will, in this spreadsheet. So what happens as the variables change? Now we're looking here. This is this last variable, and what we're looking at is the growth rate. What happens to the value of the stock as the dividend growth rate increases? You can see as dividend growth rate goes up, we have increasing stock prices, and then there becomes a point where this becomes a very steep curve. So there is a point where the actual growth in stock price becomes very, very high. It's not likely that companies would be able to maintain that for very long. Most companies are going to be down here in the 3 to 6 or 7% range, mostly just to try to keep up with inflation. What about the required return? What happens to the required return? As the required return increases, you see that we have this downturn. So for stocks, once we get to the risk chapter, we're going to find out that most stocks are going to have a required return between 10 to 17%. They're mostly all going to be in this range here. So we'll see that what? As the required return increases, there'll be a decrease in the value of the stock. And that's just an essential understanding, if you will, of assets and risk. Risk is incorporated into required return. As risk increases, the required return increases, so the value of the asset is ultimately going to decrease. So here we have a growth company. It's going to pay a $4 dividend. The dividends are expected to grow at 6% per year. The required return 16%. So again, plugging that into our example, 16%, growth rate 6%. The dividend it's going to pay here is $4. So we would end up having a stock value of $42.40. And again, you can make the analysis to decide whether or not this is a good investment or a bad investment. Sorry about that. So, what do we know about these dividend growth models, right? First of all, we expect the dividend to grow at that growth rate forever. The stock price is expected to grow at the growth rate forever. So this is an assumption that the stock price is going to be somewhere out in infinity, and that the dividend is going to grow at a constant growth rate to infinity. The expected dividend yield, the future dividend divided by the current price, is constant. Expected capital gains yield is also constant, and that's equal to the growth rate of the price and growth rate of dividends. So the expected total return for this company has to be greater than the growth rate of capital gains. So the expected return, we actually have a fairly nice formula that the expected dividend yield, dy, plus the expected growth rate of future dividends, g, is how you would calculate the total return of the stock. So if we have dividend yield plus growth, you can calculate the actual dividend yield or the expected return on a stock. And the nice thing is the dividend yield and that growth rate are sometimes fairly easy to either calculate or find. Now we do have, we had mentioned a different kind of a special kind of a growth circumstance. So let's just read this so it makes sense. Suppose a firm expects to increase its dividends by 15% for the next 4 years due to a new innovation in their production process. After the initial growth rate, though, the dividends are expected to return to their historical growth rate of 8%. If the last dividend was $1 and the required return is 20%, what is the value of the stock? Now what we have to remember is that we just have to find the present value of all expected future dividends. So we can go through the process and find the 4 future dividends. Here's D1 is the current dividend times 1.15. So next year's dividend would be $1.15. 1.15 squares, $1.32. So here are the next 4 dividends. But now that only gives us 4 dividends. We need all the dividends to infinity. And if you remember, a price is the present value of all dividends to infinity. So if we were to find P4, the value of the stock at the end of this growth period, that's D5 plus R minus G. That's our formula for value of a stock. So we can calculate that for this company. It would turn out that it's worth $94.44. So now we know it. Here are the present values of all the dividends, and here is the future price of this stock. All we need to do now is find the present values of that. And we'll actually do that calculation when we get to part 2 of this video.